Hello and welcome to a whole new week on Crypt. Oh my God, what the hell happened on Friday? I want to give you a little insight as to this massive Black Swan event that just went down that hopefully we're recovering from. And, should we be afraid? Should we lean into it? What is the correct action? Let's dive right in. Bam. Now, what we're talking about is this massive red candle just right here. This occurred on Friday, and this was just a huge liquidation event where Bitcoin comes from, it had just regained its highs of about 125 over here, and it's settling into the 122 range and just bam, 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 baby, are you down, 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 109. Now, it actually tapped 105 on venues. And of course, this is just Bitcoin. Bitcoin was much more protected from what happened here than a lot of other assets. So we saw things completely wick down. The Cosmos Hub asset, Atom, that wicked all the way to like 0.004 cents. So we just saw alts getting completely eviscerated in what turned out to be the single largest liquidation event in cryptocurrency history. Now, TCB, this is a guy I know personally, very intelligent commentator on the markets, and he says that daily candle was bigger than the 2017 Bitcoin cycle all-time high price. So the entire cycle of 2017 could fit in this just multi-hour candle, which meant to the people participating, well, shit, some massive player did something wrong. There was either a market maker, the people that provide liquidity and order the markets. Basically, they put buy orders and sell orders right above the asset prices, and they keep the market afloat, trying to make sure that when people come in with large buys or large sells, that prices don't move tremendously. Now, again, Bitcoin's going to be less volatile because you have this massive institutional buy-side interest. But as we unpack this, it looks like just one of those learning experiences that crypto continues to have. And let's turn to my trusty chatbot for just a brief list of how often we have to relearn this lesson. Now, the major thing here, crypto is about decentralization, and yet it's the centralized factors that continue to repeatedly fuck us. So in 2014, we have the OG of not your keys, not your coins, which is 850,000 Bitcoin, 450 million at the time, greater than 50 billion today. This was one of the first ones. Now, when I first discovered Bitcoin, the idea of like how to acquire it was, well, go to your bank, get a money order, and send it to Mt. Gox. Luckily, I went and I met shady dudes in back alleys, and I, of course, found different ways to lose those Bitcoin. But we move on. 2016, Bitfinex. 72 million in Bitcoin stolen via a multi-sig exploit with BitGo. And keep in mind, BitGo is around today. They're one of the biggest custodians. So, like, who really loses here, right? The industry keeps going. CoinCheck, BitGrail, Quadricus EX. I don't like these ones as much. They're a little bit more related to themselves, but we get into Celsius Network, which was a centralized lending feature. And of course, they ended up proving to be a scam from the get-go, with their founder now behind bars. FTX, of course, taking the cake with $8 to $10 billion in customer deposits because they were just simply gambling with their user funds. Again, exactly what decentralization was meant to prevent. And last but not least, we got the 2023 Binance settlement, not a collapse, but there were some losses and they paid $4.3 billion to the DOJ. So all of this is to say this industry has this recurring lesson, which is that centralized players kind of amass risk. And because we're already in this very risk-on industry, we attract a lot of creeps, we attract a lot of grifters, and well, it's very hard to trust other people with the keys to your coin. So what is going on here? And I think Elon Trades, he has a very strong take. I think there's a lot of threads of truth here. While this might not be everything that happened, it is starting to look very probable that this was rooted in Binance. And let's remember, I talked about Binance trying to attack Hyperliquid previously by creating a setup that would liquidate their Hyperliquid protection fund, basically a fee capture vault whose capital is used to protect users and their trades. Now, the October 11th crash, what really happened, and the TLDR he gives is that roughly $60 to $90 million worth of USDe. This is the Ethena-backed dollar coin. What they do to create yield on this asset is they take a lot of dollars, they put them into T-bills, they also short the price of certain currencies, and they create this sort of risk-off hedge that creates yield, whether they be long or short, with wrapped Binance ETH and Binance Network Solana. So basically wrapped versions of both ETH and Sol. And they seem to be mixing these up as collateral. So exploiting a price flaw that valued collateral using Binance's own order book data instead of external oracles. And this is what happened here, was that we see this collapse happening in Binance. Everything wicked down more aggressively on that exchange and then sort of cascaded outwards as market makers saw this collapse and were like, hey, we're not putting in new bids, or arbitrageurs began to take advantage. And of course, this all begins to build on itself. You have more activity trying to ping the API or the code that lets you interact with Binance, a That caused a DDoS attack and essentially the exchange shut down. So that localized depeg triggered 500 million to 1 billion in forced liquidations, cascading to 19 plus billion globally, and earned the attackers about $192 million via $1.1 billion in Bitcoin and Ethereum shorts opened on Hyperliquid hours earlier, but minutes before the Trump tariff announcement. So there is this interesting collusion of like who knew about this tariff announcement. Were they trying to capitalize on that news, and were they in cahoots with Binance, or did this just sort of time up terribly? So it's not a failure on the USDe asset. It is Binance's design flaw. Timed with macro panic, Trump's tariffs recovered. What looked like chaos was actually a coordinated exploitation of Binance's internal pricing systems. So the setup was Binance's unified account lets traders use things like USD Ethena, wrapped Binance Ethereum, and Binance Network Sol as collateral. So that's like a little strange that they're bundling all these together. And what's not really strange is using different assets for collateral, but the fact that they're all under the Binance umbrella. So instead of an Oracle or redemption prices, Binance valued these using its own spot market, a major vulnerability. So what happens here is that the oracles that price these assets look at the Binance markets, not at the biggest markets for these assets, which could be like Bitstamp for Bitcoin or really Curve for USDe. Curve is a algorithmically based DeFi protocol for stablecoins that tries to keep them in balance so that they maintain their peg. That is where the majority of USDe value lives. So to not look at the primary market is a bit weird. Now, as Binance begins to have this contagion internally, the oracles are looking back inside, and you can see how that begins to create a loop. So during that window, sophisticated actors manipulated Binance's order books, dumping this $60 to $90 million worth of USD Ethena, driving it way down to 65 cents. Only on Binance, $1 everywhere else. And let's keep in mind that Ethena promises as the issuer that if you buy a USDe and redeem it directly to them, they will give you $1 back. So this could have been the opportunity of a lifetime to collect a bunch of USDe for 65 cents on Binance and redeem them to Ethena. They guarantee that they maintain that. But this creates this dumb feedback loop. Because the unified account marketed collateral to internal prices, this instantly wiped margin value and triggered 500 million to $1 billion in forced liquidations. This is where leverage is so dangerous, and this is why I tell you not to do it when I sign off every day. Liquidation cascades can just keep going. And all of these liquidation engines, they're programmed in very specific ways. And we've seen the FTX collapse had a lot of liquidation cascading, and now we're kind of looking at these things like, hey, if we don't know how the liquidations work, if we don't know how you balance these things out, there's not a real reason to trust a centralized player versus these decentralized order books where you can actually see everything happening. You can verify what's going on. Now, the profit engine, the same day a fresh wallet on Hyperliquid opens 1.1 billion in Bitcoin and ETH shorts, funded by $110 million USDC. So they're going on 10x leverage from Arbitrum leaked sources. As Binance cascade unfolds, BTC and ETH crater, these shorts netted 192 millions in profit, and they close out at the bottom. Timing, precision, and funding paths all suggest coordination. So there's more if you want to dive into this. Of course, this is in the sources on my description. But while all of Binance is cascading, I tried to log into Coinbase. It wasn't working. All of the exchanges were totally shut down. Of course, the Ethereum network spiked in transaction volume, so getting a transaction through cost a ton of money. However, uptime remained. Solana uptime remained, and we saw the chains handle themselves really well. Now, Jeff from Hyperliquid comes out and he says, during recent volatility, Hyperliquid had 100% uptime. So right there, we can see that they're beating out the centralized exchanges by the simple fact that you could log on and try to get your money. But this is what's really important. If you're not in control of your money, if you can't log on to an exchange, if you can't log on to a DEX that holds your wallet, you're really screwed. So not your keys, not your coins is extremely important in situations like this where everyone's running for the door at once. A classic run. Now, this was Hyperliquid's first cross-margin ADL. An ADL meaning automatic deleverage in more than 2 years of operations. ADL does not change the outcome for any liquidated users. While some specific ADL provided trades were unfavorable, the aggregate effect of ADL was that traders realized significant P&L by closing positions at favorable prices that were only briefly available. Now, ADL, what it did was it meant that some people did have shorts open and there was no money on the other side. Perps rely on a single pool of capital. They are a zero-sum game. So if I'm going long and you're going short, we're all fighting over that pool of money between the two of us. Now, ADL comes into play when that pool of money just disappears and there's still trades open or bets. And the system just says, well, you're shit out of luck. So if you shorted into this thing and you got ADL'd, it just closed your account and it said, we're treating this as it didn't exist, and it's too bad. And that's something that obviously made people angry, but the fact was they had some access to their capital here versus the centralized exchange world where this was just not even available. Now, look, he goes on to talk about reputation and people attacking it, but the background on liquidations, he talks about the perp system. He talks about the Hyperliquid Protection Fund, which is a protocol vault with permissionless deposits that provides order book liquidity, performs backstop liquidations. The first role is negligible, with HLP trading less than 1% of its market share. The focus of this post is on liquidations. Now, liquidations are first attempted against the order book, and any user can provide liquidity to these market liquidations, meaning you can hop in and make a trade. Backstop liquidations occur when the order book does not have enough liquidity to absorb an under-collateralized position. In this case, HLP takes over the position along with its collateral. For improved risk management, HLP is split into several child vaults. Each liquidation is only sent to one child vault. And let's recall, just to go back, the Binance attack was exactly this, which was trying to get HLP to absorb the entirety of a wildly uncollateralized position. And of course, they survived, and it looked very much like Binance was trying to take them down. So again, this is kind of in depth, and if you want to dive into it, it's meatier than what I like to talk about. But he also comes out with transparency reports. Says, look, Hyperliquid's fully on-chain liquidations cannot be compared with underreported SEX liquidations. Hyperliquid is a blockchain with every order and trade, blah, blah, blah. He basically talks about how it's all on-chain, it's all transparent. However, some SEXs publicly document that they dramatically underreport user liquidations. For example, on Binance, even if there are thousands of liquidation orders in the same second, only one is reported. That's because the liquidations happen in bursts. This could easily be a 100x underreporting under some conditions. Now, if we assume that 100x is the top of the band, but we're looking at a $20 billion liquidation event, we could easily be talking about significantly more than 20 billion. So again, this comes back to not only not your keys, not your coins, but also not your code, not your freedom. And this is just something fascinating to watch. Now, again, we've been through this so many times, right? Whether it be Mt. Gox, whether it be Bitfinex, whether it be Celsius, and whether it be FTX. The industry has learned, and we've learned so much since FTX because that was such a publicly facing event. This liquidation event was a cascade that really only impacted leveraged traders and day traders. Those are crypto degens. Anyone that was long Bitcoin, I mean, it went down from 125,000 to what? Lows not seen since a month ago. So if you're spot long Bitcoin, spot long ETH, you're pretty okay. This flash crash was like, if you didn't even pay attention to it, you might not have known that it happened. However, everyone that had open interest, all of that longing and shorting and that leverage trade, they all got liquidated. They all lost 100% of their collateral. They got completely wrecked. And the learnings from this are phenomenal. So Ethena came out with a conversation around their DPEG, and they proved that the USDe asset was over collateralized the entire time. It was always safe. In fact, this cascading event, due to their trading strategy, had a short position, and they earned even more collateral against the asset. So USDe has something to pound their chest about, and a marketing campaign that they'll probably run, and they should run moving forward. Now, we've got Simon Kim from Hashed, a venture fund out of Korea, and he goes into a little more details that, like, guys, we got to turn towards the decentralized world. We're now at a place where our products are demonstrably better. A few months ago, I shared my perspective on the market and the competition between DEXs and SEXs. Sure, he goes into it. On October 10th, we have this auto deleveraging event, yada, yada. Meanwhile, Aave successfully protected approximately 4.5 billion in positions by switching from a single exchange price feeds to redemption value-based oracles. Hyperliquid X earned significant trust by maintaining uninterrupted operations and transparently disclosing their liquidation logic. What emerged starkly from this crisis was a tale of two infrastructures, and this is what we are just going to have to ride with and push forward because we are finally ready to leave these SEXs behind. Sure, their order books are great for day traders, but they're not benefiting anyone else. They just build up these risk profiles, and when they pop hard. Now, the real insight here isn't just about technology, it's about trust architecture, and that is what crypto is about. We have been architecting trust. The first thing that we do with digital trust is money, because you need to know that money is worth something. We need to trust that if I get $1, I can spend $1. But this comes back to AI. This comes back to image generation. Who made it? Is it real? Is the data and the information that we're getting from X from a verifiable source, or was it coming from a bot pumped out of Russia? All of this is extremely important, and this is where crypto matters. Now, This painful market event has illuminated precisely where our industry must evolve. And I believe these centralized exchange failures will accelerate the migration towards decentralized alternatives far sooner than anyone, including myself, previously anticipated. The catalyst I predicted for 2028 may already have arrived in 2025. And of course, we have Hasib, partner at Dragonfly, and he goes into his dive about the Ethena deep peg. And his take is quite a complicated one on, did it actually deep peg? And the reality is people are looking at this deep peg, this USDe price on Binance, where again, they were looking at themselves. So Binance looked in a mirror, based their next move off a reflection of what they saw, then looked back in the mirror, based their next move off a reflection of what they saw, and so on and so forth. But Hasib kind of backs me up here to say, hey, look, USDe on Curve had like barely any impact, and we should have been looking at Curve, never at Binance. Look to where it is, and let's keep in mind, Curve is decentralized. Aave is decentralized. Hyperliquid, their code is open and they're moving towards decentralization, but they are arguably more decentralized than Binance. Of course, we have Thorchain, which is operated by the community. We have a variety of SEX and perp products that are just increasing in robustness. We have near intents that allow for cross-chain swaps and are doing serious volume. But this is a very fun take if you want to get into the weeds. Again, I do agree that the simplest explanation is that the peg was always maintained so long as Ethena was willing to give you $1 per coin. If anyone remembers back in the banking crisis under Biden, where they actually forcibly closed the banks, USD Circle on a Friday depegged, and there were no banks open to help them just make the redemption. So over the weekend, you could have bought USDC below $1 to sell it the next day when the banks reopened at $1. I did this as aggressively as I could. I didn't have much money, I had a couple grand that I put into it, but it was an amazing opportunity. It was like, hey, do you want to buy $1 for 95 cents? Things like that. And these kind of events happen, and they just kind of show you that if you want to live your life and generate wealth, there's two amazing ways to do this. One is just to buy assets you believe in and go to bed every night and sleep on them at spot, whether that be Bitcoin, whether that be gold, whether that be the S&P. As long as you're not leveraging, you're not at risk. You just ride the wave. If it goes down, you sell it tomorrow when it goes back up. The other way is to have some cash in your pocket and wait for cataclysmic events like this. What happened here was that the entire alt market got completely crushed. This comes back to the market makers not wanting to put in any bids. In a slow cascade, a market maker with a client, which would be an altcoin, for example, would have a reserve of tokens. A lot of times they're buying and selling those tokens. They're trying to stack dollars at some point, so if it goes down, they can start buying it back up. However, when you see liquidation cascades and a market just collapsing, they have that coffer, that stack of cash, and they go, I'm not throwing the cash into this. We're cascading. If I put money in, it'll disappear. So that means lower lows keep getting hit. And to use a standard term, when the tide comes out, we see who's swimming naked, which means that a lot of coins just had no real price floor. We can see that there wasn't good demand. Now, some of them went pretty far down and hit a wall. There was organic buy volume. There were people out there with old bids, stink bids, which just means like maybe it goes so low I get lucky, and they were willing to actually buy these assets. Other ones were not. They were just market maker purchases. And I do think we've wiped out a lot of alts. People will look at the ones that just kind of had an endless bottom and just say, you're trash, and this market event proved it. Now, what we can take away is that the industry writ large is ready to go to decentralized exchanges. This cycle, more than any, has ones that are actually ready to accept our volume. And while that volume is being maintained, it did show that no single chain can really support what Solana is putting out as NASDAQ on chain. As everyone tried to withdraw orders, chains did congest. Now, that doesn't mean they slow. They still produce blocks at the same time, but getting included in a block becomes more competitive. Remember, there's markets in block space. It is a free market system. However, anyone can directly access these chains and force their transaction into a block if they're willing to pay for it. So that is the way that these are supposed to work. However, it was a clear event that scaling is very necessary. However, for the first time, we have things like Hyperliquid, which has already had a very organic traction, and things like Ethena and things like Aave just showing that they could actually take a black swan event. And unlike March 2020, which was a terrible time for crypto right before COVID, everything went down. This happened in such a tight period of time. This was largely driven by bots, by automated liquidations, and just things that as a retail investor, you're not going to catch this knife, right? If you went out on a jog, you would have missed all of this activity. So that being said, we reset everything. We have a new world in front of us. As always, don't over lever. Look for some good coins. It was a good weekend to buy. Stay safe. Give me a like and a follow so I can continue to simplify what's going on for my humble followers. And of course, I will see you tomorrow.